This is now the second trip I've taken here this year, and I'm sensing a very, very different landscape from what it's been in the past. And I think there's a very genuine willingness in all branches of the government, the legislative side, the regulatory side, the executive branch, to really put the US on a very strong foundation and put it even in a leadership position in the Web3 world and in the blockchain industry globally, which I think makes a lot of sense because the US's position in the global financial system is one of the defining characteristics of why the US is the US. And so as the global financial system transitions to this blockchain-based format of transactions and assets and interaction with all the counterparties in the global financial system, I think it's very important for the US to maintain that position. And so these are very important kind of conversations and pieces of progress that are starting to be made now, I think basically from the start of this year with the new administration coming in as a very big catalyst. And it's very, very good for our industry. It's fantastic for the blockchain industry. But I think it's also going to be very good for the US if it can be the most kind of high quality provider of assets with the most reliable infrastructure and the most reliable guarantees, which is what it provides now in the internet-based traditional financial system. So I think that's really what I and many other people are hoping will happen for the US, that it'll retain that position in the global financial system, because as it transitions to the Web3 blockchain format, the US can be the leader and provide the best assets and provide the best infrastructure and provide the best guarantees for those assets and for payments and for everything works. And that's a very exciting, very positive direction.
Well, thank you for that. And, I would say just one comment that we've seen as the Digital Chamber, it's been amazing. Everybody knew that the U.S. has the best capital markets and normally the most regulatorily innovative and permissive environment to allow innovation to be housed here in the U.S. But I still kind of day by day am surprised in how the flood of companies that were dying to get into the U.S. and to really address the U.S. market, how that pent up demand has really exploded. So that's been really interesting, exciting from our perspective in the industry. But I would like to start, Tyler, I think some of the things that Sergey touched on in this new relationship and this new paradigm in the U.S., lots of folks in the industry are asking us questions, into the ether, so to speak. And how is this administration, addressing this industry? And I think it would be great to hear what you're able to share about your role at Treasury and what you're focused on.
Maybe I'll give one disclaimer and then answer that question. So the views are my own, not necessarily the views of the department or views of the secretary. I've been at the U.S. Treasury Department. This is my second tour of duty there. I worked in the first Trump administration for Secretary Mnuchin, came back obviously to lead the digital asset work at the department. And I think what is exciting in front of us is we've been in sort of this regulatory morass in the United States on digital assets for the past 10 years. And we have a whole of the government reset approach here. And we saw President Trump issue an executive order that explicitly spoke and consolidated sort of the ownership of this issue with David Sachs, the new crypto czar. And we have really aggressive, tight timeframes. And what I see just from the inside is everyone on the working group working together, producing materials. These SEC and CFTC are fast moving ahead of where the government is right now. So I see all of the pieces of the puzzle moving in one direction, which is to advance the US leadership on digital assets. And that is a wholesale change of where we've been over the last several years.
Yeah, it's really every position of consequence inside the federal government so far has been filled by somebody that is cognizant, conversant, and positive, it seems to me, on the issues.
And maybe I'll just unpack a little bit for people who don't know how Treasury is orchestrated and what equities we have that affect the digital asset space, because it's quite a number of different things at the Treasury Department. So Treasury has core 3 verticals. There's domestic finance, and domestic finance typically works with the prudential regulators, the bank regulators, works with the market regulators, sort of advance the US government's views on these core economic issues. There's not a ton of regulatory control that the domestic finance sleeve of Treasury has. International Affairs is the spokesperson for the Treasury Department as a finance ministry. They go around the world selling the US message. And then you have the TFI vertical of Treasury, which is primarily FinCEN and OFAC. If you look at just everything that the Treasury Department controls, its tax policy, the forms and the guidance that are issued to consumers and businesses, the AML regulatory regime and the BSA, and sanctions list. So it's quite a number of things that have been confounding issues for the digital asset space for quite some time. So needless to say, within the executive order, we have our hands full with work inside the department. And I've only been there for 3 or 4 weeks at this point, but we have a strong, very good team of talented professionals across the department that are engaged and eager to work on this issue. And I think they're excited about the prospect of having a refreshed view from the government on this issue. And I think to many people, it's been sort of a conundrum of why they're looking at digital assets as sort of this sort of tricky issue. More so, they should be looking at how can we advance the U.S. economic interest by working with industry and learning from them. So I think that's what we're here for. We've been doing lots of industry engagement. So I would say to everyone in the crowd, if you want to come talk to us, come do it, because we need to learn from you.
And would you say your role then is sort of covers all 3 of those verticals? Like
It's across the department, it's across all of the bureaus, and working very close with David Sachs and his team. I just think everyone in the working group within the executive order is working hand in glove together. Inside the department, it's a job for 3 or 4 people, but we're doing it. And we've got a big team that's very collaboratively working together inside the department.
I'd love to hear both of your thoughts really on what you think the lowest hanging fruit is and what we're looking at over the next several months and maybe this year, but also the kind of medium to long term, what smart contracts and blockchain can do to modernize and push our economy into the next decades. Please, yeah.
Yeah, sure. So at a high level, I think there's 3 important dynamics to keep in mind. I think the first important dynamic is that when the U.S. Financial system in its current form was taking shape, the U.S. had a very big technical advantage on internet technologies. So if in the 80s and in the 90s, you went to Europe and Asia, Europe might be 4 or 5 years behind, and Asia might be 10 plus years behind in internet technologies. At the time when everything was moving from mainframes and legacy databases into the internet-based version of the financial system, right? So it's very natural that the leading financial infrastructure and products and user experiences like E-Trade, interactive brokers, various internet-based exchanges emerged from the US, right? Because there was this undertone of the US is experiencing this massive lead in internet technologies, right? Many of the backbones of the internet were housed in the US in an infrastructure sense, the technologies, the companies, HTTPS, all these innovations, right? That is not necessarily the environment that the US is in currently. The environment the US is in currently is that the technology of Web3 and blockchains is equally distributed across the world, right? So it's equally available to everybody that wants to build financial products. So that 5 to 10 year plus advantage of having internet infrastructure, basically expertise and experience and ability is not the same advantage in this case. So it's a significantly different situation in that sense. The second key point is that the US does have the biggest capital markets that are still considered to house the best assets that people go to in the sense of quality and in the sense of a flight to safety. And that's as a result of the legal system of the US and its ability to resolve fraud and conflict and its ability to have reliable regulation And so the US does have the largest collection of reliable, high quality assets due to that system. That, I think, needs to be converted into a Web3 blockchain format where the base asset, the fundamental on-chain asset that everyone then repackages across the world and globally rewraps it again and again, whether that's through DeFi, whether that's through some version of blockchain TradFi, that the base underlying asset is ideally created and issued in the US, right? That would be the ideal situation for the US financial system, is that the base asset, whether it's a currency asset or whether it's a financial markets kind of tokenized fund or non-currency asset, you fundamentally want the asset, the base asset that then can be rewrapped and restated and reshipped in 20 different ways to 20 different places. You want the fundamental value to originate in the US financial system. And then the third thing that I think is very important is allowing the friction for the acquisition of that asset to be low. This is where regulation and regulatory clarity and how to automate transactions to make it easy for everyone globally to acquire that asset and actually wrap it and make it portable to other places is what will allow that base asset to gain popularity the way that existing financial assets and the US dollar has gained a lot of popularity, right? Really, if those two things, the base asset being in the US and then the asset being portable, isn't something that comes out of the US transitioning to Web3, that could be a concerning situation. But if the US is the place where you originate the base asset and then taking that US originated base asset and making it very available and very easy to acquire and making it very reliable and making it very attractive to the rest of the world's financial systems, that will allow the US to retain this key leadership position in the global financial system, right? So really, kind of, that's a more technical answer to your question. But the answer to your question of what's at stake is the US financial system the leader of the global financial system, right? And then the only caveat in our industry is, will the global financial system be reformatted into a blockchain-based state? Which I think yes, right? I think the entire financial system and all currency and everything will be reformatted into a blockchain state. So then the question is, what is the US's role in that new blockchain-based system? Is that sense?
Absolutely. And I think this is probably a statistic that you both are familiar with, and maybe some of the folks that are here today, that over 99% of stablecoin or activity on chain is denominated in US dollars. And I'd love to hear your thoughts on this too, touching on assets that are tokenized, that they'll be able to move cross-border much more efficiently and cheaply. That advantage, I think, becomes more important. Is that something that you see as well, and Tyler, from like a Treasury US government standpoint, in terms of our position in the world financially, like being the base, the world reserve currency, and then extending our financial system beyond that to other financial products and services? Is that something that you see as?
I think there's definitely a void to fill, but maybe I can just go back to, I think one of the questions, or the original question that you asked, was like really about why this has happened so slowly and why we haven't seen adoption quicker. I think if you look at just the clarity issue from what traditional financial institutions and traditional participants in the US financial economy, how they've been sort of pushed away from touching and interacting with the community, like the impediments that have been there for those participants have been largely driven by the regulatory complex and sort of the overhang that has existed in Washington since 2022, and some of the issues that came in place in the digital asset market in 2022. If you just think about SAB 121, if you want traditional custodians to participate in the space, it has to make rational sense for them to do so.
Yeah.
So I think we've seen a little bit of a cleanup on some of these issues, and that's going to unlock some of the frustration that has been for the traditional financial regulatory complex to participate in digital assets.
And day by day, we are seeing some of these walls and fall in court cases and some of the rulings and even just the posture of some of the agencies that.
And not to speak for the SEC or anything, but we've seen the activity that they have embarked upon. And we've seen they've set up a crypto task force with Commissioner Peirce leading that. And we've seen them put out tons of questions of things that they need substantive engagement from the industry to give them thoughts and feedback on. That promulgation or putting out the questions to the industry, that's a marked difference than where we've been.
And Sergey, I know that we've talked about stablecoins and you touched a little bit upon what could come next. Are there financial products and services that you see are sort of the lowest hanging fruit beyond use of stablecoins? I know Chainlink is as an Oracle provider and some of the tech that is built there, feeding insurance applications. Or what do you think is most interesting or maybe the lowest hanging fruit beyond stablecoins?
So stablecoins are really a form of payment in the vast majority of cases. There's just always two sides to this equation. There's the form of payment and there's the asset that you're buying with the form of payment, right? So the stablecoin for me is a payment rail, right? It's a new payment rail that has all kinds of efficiencies. And the more people that have stablecoins, the larger the market is that can buy the asset, right? So that's how I view stablecoins, is that the more people have stablecoins, the more institutions allow their clients to use stablecoins, the more of a frictionless user base to buy a blockchain-based asset. Now, the blockchain-based assets that are now popular, interestingly, despite the cryptocurrency's original stuff about replacing the government and whatever government things, is U.S. Treasuries. So the real use case for blockchain technology after speculative cryptocurrencies and meme coins and so on is tokenizing U.S. Treasuries, whether it's in a fund structure or whether it's in a more direct form. And the reason for that actually is twofold. One fold is the yield that you get from those treasuries, which has obviously gone up massively to very, very big highs on a recent time scale. And the second reason is actually that the need for diversification in the on-chain financial world is very, very great. So many of the failure modes for financial products in the on-chain world is that it's a crypto thing backed by a crypto thing with an underlying asset of a crypto thing with collateral of a crypto thing. And at the end of the road, and then that is wrapped up and secured by a crypto thing. And so when the crypto stuff goes down in price, it's not so good for everything that's collateralized 3 levels up or down by crypto stuff, right? That's where you get collapses like Terra, right? Where things can very rapidly devalue because they're so tied to one asset class. So actually the public blockchain world is willing to pay a significant premium for diversification, more significant than the traditional financial system where you have a very large array of financial products to create diversification. And US Treasuries are pretty far from, the crypto thing. I think what's going to happen next is you're going to have more and more assets that create greater and greater diversification. And they help the on-chain financial world manage risk. And then you're also going to have new asset types that historically were very hard to own. Fractional ownership of real estate, fractional ownership of some kind of private equity fund, things that you want to own, but the cost of owning or the cost of transacting in or the cost of creating a market in was just too large. And then the third thing that I hope will happen, which will make the crypto version of the financial system the best version of all financial systems, is if someone can finally figure out how to get yield on traditionally non-yield bearing assets, like gold. That would be a very big deal. But I think those are the three things.
The point that you started with on the layers of assets and relying on one another in the tokenized world and blockchain. Could you chat a little bit about real world assets and proof of reserves and what role that may play and I'd love, Tyler, from your perspective, if you see that as something that's of use and utility, and from a requirements, regulatory, policy-wise, from a government perspective. But what is, maybe you can tell us, like, what does that enable?
Yeah, I'll briefly explain proof of reserves. I really want to hear your views on that as well. Proof of reserves is the beginning of a category of proof of things. Proof of reserves proves that a stablecoin, for example, actually has assets backing it, basically. That you're not just taking the word of some company, that the assets are there, or that you're not taking the word of some audit cycle that might be a year long, right? So proof of reserve basically takes the audit cycle of an asset down from a year, down to however often the proof of reserves is proven. In many cases, for us, it's down to a few seconds. So you're automatically verifying that the assets are there. And then there's actually a way that proof of reserves works, where you can control whether a new asset, whether a new token can be minted or not, depending on if proof of reserves proves that there is an additional unit of off-chain real world asset, right? So you can't mint an additional stablecoin unless the proof of reserves proves that there's an additional dollar in the Treasury holdings you have, or the bank account system you have. Same thing for commodity coins, same thing for a lot of stuff. But proof of reserves for me is really just the beginning of proof of a lot of things. Proof of liability, proof of solvency, proof of composition, proof of many things.
I entirely agree with what you just said. I was just thinking about how to phrase this. In Washington, people sort of started to pay attention to the crypto community in 22 in earnest, and try to think about what do we do from a regulatory policy perspective to protect consumers, et cetera. And there was a bipartisan effort in maybe early 2023 to provide proof of reserves and to require it for custodians and exchanges and people who were taking control over an individual's assets. And so I think it may end up being one of the great use cases that Washington wakes up and sees. If you can cryptographically prove that you have custody and ownership over the assets that you say you do, and you can do it in a very real-time, instantaneous manner, that's pretty powerful. And you can see how that would be transposed into many different aspects of traditional finance as well.
From, we're touching on policy, regulation, compliance issues here in the US. As we build that out, hopefully this year, and of course over the coming years, hopefully we'll get some major questions answered in the coming months. But as that sort of forms and becomes more granular in the US, how do you see those regulations that we are instituting and coming up with, interacting with, dovetailing with with our partners, our allies, and enforcing some of those, trying to keep the worst actors out of, from doing the worst types of things and illicit finance types of issues?
I guess I'll jump in first. I think we've been a world leader in sort of setting a high floor in terms of the thresholds and requirements that we place on institutions and intermediaries. And I see no reason why we shouldn't continue to be that world leader in this space. We're just starting a little bit of a different place than some of our other peers. So I think an unfortunate outcome we'd want to avoid, at least in my mind, is some of the rule book harmonization that we saw in the efforts from Dodd-Frank. That didn't happen in a seamless manner. So we just want to make sure that as we're thinking about instituting our new regulatory regime for its stablecoins or market structure, we just want that rule book to be as seamless as possible with the ex-US jurisdictions, so it doesn't have like a timeline issue of implementation.
So getting it right on the front end as much as possible, and
getting it right on the front end and ensuring that it is as nimble as possible, because the industry is going to move faster than we can write rules and we can do policy.
And Sergey, I know that blockchains are international, borderless. From a perspective of a international firm that is doing business in lots of jurisdictions, how do you think through the different jurisdictions that you need to be compliant in? And do you see the US as sort of leading the way now that we've, in essence, finally thrown our hat into the ring and as sort of being the standard that other jurisdictions will kind of fall into line with?
Yeah, so there's a few questions there. The way I tend to approach all of this different jurisdictional stuff is to reach the end state of completely automated compliance. So I think the world that you want to end up in the final end state of all this, is where all compliance can be completely automated, because you can put all the data into a contract. The contract can resolve the conditions in a cryptographically guaranteed way that doesn't rely on people and doesn't allow mistakes, very costly mistakes. And so you switch from a world where you have huge amounts of people doing compliance in different ways with different policies, different formats for compliance, to a single, clearly defined, technically prescripted way of doing compliance that's completely automated, right? So that's the end state that I think everyone, once they really think about it, once they understand that that's a possibility, I think that's the end state everyone actually pretty much wants. Getting to that end state in different jurisdictions is dependent on a few things. It's dependent on how progressive and crypto positive the jurisdiction is. That's probably the biggest factor. I've worked in Singapore, I've worked with HKMA, I've worked with various central banks all over the world. We're publicly announced as working with, I think, 4 central banks. And there'll be more on the way from the work that I'm seeing progress. And so the biggest factor is how crypto positive the central bank or the Treasury or the regulator of that country is. The US, to your point, your question of is it the leader in this right now? Well, I think the US is taking very good steps, very necessary steps, and very rapid steps to start going in that direction. It's definitely not in that position now, because as you said, they have thrown their hat in the ring, right? So you kind of threw the hat in just now. Doesn't happen overnight. And there's been people in Singapore at the MAS and in various other jurisdictions that their hat has been in the ring for 5 years. So that isn't overcome in 2 months. But definitely there's very, very, very different mindset now in DC. And that's kind of why I'm here, because I've seen this mindset before in other government structures all over the world. And it's a very productive mindset. So it's very positive and it's very productive. The fact that, Tyler even has the title that he has and the role that he has, and that he has multiple people, as he said, working with him on this, is very, 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 very positive, right? So I think the US can reach that level of positivity. The second key factor is whether or not you're able to get everyone to agree on what a regulation should do. That in the US is a little bit complex, because in other countries, the central bank is the Treasury, is the regulator. It's all in one building. It's literally one building. And sometimes the people are on one floor of that building. So it's a little bit different. There's a lot more people that need to agree in the US. But that's kind of the US system of checks and balances. It's not necessarily a bad thing, as long as they can be made to agree. So I think the US needs to be very crypto positive, and it needs to get to agreement across who's responsible for what, and then it can leverage all these very large advantages that it has. And it definitely has that momentum right now, right? And I hope that momentum continues, and that we can help.
I guess just to add a couple things, I think about it maybe a little bit more simply. Like, we just want to be a net producer of the rules and the outcomes from a regulatory policy lens versus a taker of those. And right now, I think I totally agree with you. We've been in a little bit of a stasis point because other countries and other regulatory jurisdictions have been moving faster than us. And we're playing catch up, but I think it's very positive to see the fact that Commissioner Peirce has her crypto task force stood up, the fact that David Sachs and Bo Hines are at the White House working on crypto and AI policy, the fact that I have a job at the US Treasury Department working on these things. These are all very positive things. And I just think that we're going to rapidly run as fast as we can to make sure that we're not taking from other jurisdictions.
touch on a point that you made a moment ago in terms of the government's role in facilitating adoption. What things that, of course, we're talking about policy and regulation and how we can have clear policy and regulation in the U.S. In addition to that, are there other steps you think that the U.S. government can or should take to help adoption grow in the U.S. in terms of grants? And I know this is other legislation beyond market structure and stablecoins. And I know it's a little bit, it's sort of an interesting dynamic that the industry is now in, coupled with some of the court ruling last year around the Chevron case, that it's actually sort of pushed more of the detailed policy and law back to Congress rather than into some of the enforcement and regulatory agencies. And so I wonder how you see that dynamic where we need to, like you said, move fast, and the industry is always going to move faster in government, especially this industry. What do you think that the government can do to sort of keep pace with the growth of the industry and encourage adoption of blockchain and growth?
I think the highest near-term thing that we can do is be as supportive as we can to our friends in Congress who are actively working on stablecoin legislation. I think that's something that's very near and close. And I know the chairman's going to be here in a little bit, so I don't want to steal too much for what they're working on. But I think if we can get that done, that's a very good use case for the industry in Washington. And if we can put a regulatory wrapper around it in a way that allows states and bank regulators and all of the ecosystem to live in the same rule book to be an issuer, I think that's like a pretty good outcome for DC.
And to your point again, it seems like we have central coordination stemming, starting at the White House and flowing out to the agencies and departments.
Absolutely.
And so that's been really encouraging to see that.
3 weeks ago, we had David Sachs, who went up and spoke with the four corners in the House and Senate on exactly this issue.
Sergey, from your perspective, is there a wish list? I know, of course, we have the major bills that we've been talking about for a couple of years now, but we're getting closer, hopefully, to having passed in the coming months of stablecoins, market structure, and then some related work in tax and other issues. But is there your Santa list of other rules, other support from the U.S. government that you think would be useful for the blockchain digital asset industry beyond those?
Yeah, I mean, there's a few things that initially come to mind. It probably won't be an exhaustive list because we're still forming our thoughts on some of these topics. But the way that legislatively it was required for there to be risk rating agencies, that was a positive development for the US financial system. I think requiring that proof of reserves, proof of composition, proof of solvency, that different proof ofs are a requirement for different asset types will be a positive thing that makes the assets generated in the US financial system more reliable and more attractive. That's an obvious piece of low-hanging fruit. There was this initial interest in proof of reserve that you mentioned a few years ago. So there's clearly value there in the eyes of reducing risk, in the eyes of regulators and the larger DC community. That's a clear example. There's other examples around, in my opinion, how to make it more frictionless for a tokenized asset that originates in the US to be acquired and wrapped by a DeFi protocol or someone else, and then acquired internationally, so that the ability to gain distribution and allow the international financial community to acquire the asset becomes easy for them. And the burden of doing that is low, and the cost of doing that is low, and the compliance requirements of doing that are manageable. This second category relates to all kinds of compliance-related activities that are defined in various places in the US government, different places, some with identity, some with other compliance requirements, some with accounting requirements, some with transfer agencies, some with the calculation of valuation data. I think, the simplification of how all those financial products work on chain is really the second big group of things as a group. And my whole worldview of this whole financial system question is that it's completely automated, it's completely on chain, and that actually provides a lot of compliance and a lot of efficiency and a lot of globalization and distribution.
Is there anything that we covered that you want to go into more depth?
I would just say to the audience, feel welcome to come in and talk to us. We could benefit from all of the smart folks that are in the room. We could benefit just learning what we're missing.
And I think that that's a great message and maybe the clearest sign of the change that has taken place over the last few months, because it was a desert. It was a desert island. The industry felt to send an email into the abyss to try to have a conversation with certain folks that had purview over some of these issues. So that is a welcome message to hear from you and as representing Treasury up here today. So thank you both very much. I appreciate it.
Yeah.
Thank you.
Thank you very much. Thank you, Tyler. Of
course.
Great chatting. Thank you.